Good morning, everyone. Anthony Iser here with another ITPM Flash. Well, recession fears have eased a little bit, down from 65% at the start of April to about 40% now, as you can see on this polymarket chart. What's the driver of that? The driver is fear that tariffs are not going to be quite so bad as they were. And that seems to be the case. We've got a pause going on, 90 days, 145% tariffs with China down to 30%. However, the risk has not gone away. It's been kicked down the road for 90 days. Deals still need to be done. So that risk hovers over things at the moment. It's still going to drive uncertainty from the corporate level and uncertainty from the consumer level. In the meantime, we've had the markets have the biggest rally back to up for the year, and the quickest rally, or one of the quickest rallies in the history of markets. In light of that, with potential weaker consumer, potential issues around inflation, Fed being too late, and $15 trillion worth of debt to be refinanced this year, I think there is still that risk. 40% is a big number, and equity markets are not pricing that in. Now, at ITPM, we want to be reasonably market direction agnostic. Of course, we're going to have a portfolio bias, but we'd like to be able to make money in either direction, and whether the moves are big or small. If we see a recession, the move is going to be big. So I want to have myself an insurance trade, an outlier trade that will profit greatly from that 40% coming through, that 40% chance of a recession, and it provides insurance against other parts of my portfolio that might not do quite so well in that environment. There are three big issues. Tariffs haven't disappeared, consumers weakening, and the bond market is still down. We've got $15 trillion worth of debt that the government needs to refinance this year. They want bond yields down. They want to be able to do it at lower levels. That's really not going to happen without a slowdown in demand. So we've got a whole bunch of things at play, and we've still got a 40% chance, according to markets or betting markets, of a recession. Tariffs with Vietnam, Bangladesh, Thailand, all 36 to 47%. Mexico is 25 and China's 30 for now, but still deals to be worked out with all these groups. In the meantime, consumers are finding things a little bit tough. 90-day plus delinquencies, you can see here by type of loan, going up no matter what the loan is. And we've got one big one in there that you can see, that red line. Student loans are back on the agenda. This is going to impact people. It clearly is. We've gone from 0 default to 6 to 8% default in just a matter of weeks as those loans have been asked to be repaid again. All of this is symbolic of a slowdown in consumer spending, a slowdown in demand. The housing market is also telling us the same thing at the moment. Housing markets tend to lead into a recessionary environment. The outlook that consumers have for their own real income is pretty negative as well, as you can see from this chart here. Now I'm going to focus on the middle third and the bottom third because I think that's where there's an opportunity, because unfortunately, those people are going to suffer a little bit more in a slowdown should it happen. You can see here, unemployment is ticking up. It's a lagging indicator. It's only when we're in a full-blown recession, those grey lines, that you'll see it slide up strongly. However, it doesn't tick up like this historically without moving up strongly. And I think that's what is a real chance of happening. Hence my desire for an insurance trade to protect against that. Now, just back to tariffs briefly. Tariffs disproportionately impact low margin businesses, as you can see from this example here. Ralph Lauren, 68% gross margins, Costco, 11%, Walmart, 24%. A 25% tariff on $100 worth of goods means that Ralph Lauren's got to put up the cost of their clothes by $8. Costco's got to put up the price of their goods by $22.25 and Walmart $19 in order to maintain that profit margin, the dollar profit margin. Now, disproportionately impacting Costco, they have annual membership, which is almost 100% profit. That allows them to charge lower prices and have lower margins, but it means that they're going to be disproportionately hit if these tariffs remain. On top of that, we're going to see quite possibly consumer slowdown at the bottom and mid-tier components of the socio-economic groups, again, disproportionately impacting them. Now, Costco has been a stunning performer and is a go-to defensive name in market sell-offs, but that's on a relative basis. Go back to any major recessionary environment and we still see Costco's share price fall. It's just not going to fall as much as Nvidia's or Lululemon's or any other high growth tech name that's more cyclical. It's defensive in nature. However, that go-to performance was a function very much of its multiple, as you can see on this chart here. From 2005 to 2019, it traded, the first part of that time, pretty much between 10 and 15 times next 12 months earnings, which are the grey and blue lines on this chart. Each of these lines represent next 12 months earnings at a PE multiple of 10, 15, through to 50 at the top. So you can see it saw multiple expansion as those earnings ticked up quarter after quarter and displayed its defensive nature. And it finished 2019 at about 27 times. If we look on the next chart though, we can see that 27 times is as low as it's been for the last 5 years since COVID. It recently touched 60 and is now sort of 52, 55 times and trading at about $1,000. This is a big issue if we see a slowdown because the nature of its defensive move was the fact that it used to trade on 15 times and its PE would contract down to 10, 11 or 12. And yes, it went down, but not as much as everything else. At 52 times, it would be perfectly reasonable that if we saw a contraction in earnings from Costco, that their PE multiple could slide back to 35 times. Based on current next 12 months earnings, not even the ones that might eventuate in a recession, that's a share price of $660. That's a pretty big decline. It would be perfectly reasonable to see it get back to 30, where it was just 2 years ago. That gets us down by almost 50%. Now, I'm not expecting that to happen. It's a possibility, but I want to have an insurance trade that's got a better chance to paying off. So I'm not structuring a trade that is going to be down 50% on Costco. But if I look at drawdowns from its peak, 15 to 20% has happened quite a lot over the last decade and a bit. In fact, it's probably happened about 10 times, more than 15%. It was down 17% just from the start of the year through to April in that panicky sort of sell-off. If we see a recession coming through, if we have concerns in the bond market, if the Fed's going to be late, if tariffs don't get sorted out, we have a decent chance of a recession still, 40% according to markets. So I don't want to go and structure a portfolio for that outcome, but I would like some insurance. So I can see 15 to 20% down in Costco is a perfectly reasonable trade in that environment. And one of the reasons why I'm looking at this one is because it's not priced that way. We can get substantial payoffs for those declines. So the two structures that I'm looking at is August, to give myself time through to the next result, through the summer, allow for these tariffs not to be sorted out if they're not going to get sorted out, allow for things to get worse. August, 880 puts, buying those, selling 820s in a bear put spread. The cost is $6. I can do that 10 times. My outlay is at $6,000 on my theoretical $100,000 portfolio. I've got a 9-to-1 risk-reward ratio on that. Pretty good for an insurance trade. I can put it on, $6,000 outlay, I've got a $54,000 payoff should the share price fall to 820, which it will do in a recessionary environment. And that's what I'm looking to insure against, so that I can stick there with all my other normal ideas, knowing that I've got this scenario covered. Now, we saw there that it would be totally reasonable to see that multiple contract. So the twofold things driving the share price here. We're going to see smallish earnings decline, that we're going to see multiple contraction come through. And that's the big kicker. And if it comes to 35 or 30 times, we've got a share price that's got a 5 or a 6 in front of it. But again, I don't want to look that far down. So there you have it. Tariffs, consumer slowdown, $15 trillion of debt. The Fed's likely to be late. So how does this play out? If that all plays out that way, we've a chance of recession. Markets are still saying 40%. I'm protecting against that, so then I can sleep at night, focus on my other ideas structured in a more traditional ITPM way. So there you have it. Costco, my recession insurance trade. Talk to you again soon. Bye.